Knowing how to read the chart and the candlesticks will determine how you actually trade. What I mean by that is, it will dictate whether you trade based on you predicting where price is going to go, or whether you trade based on the evidence on the chart where you plan your trades for whichever price direction does go. Now, there are hundreds and hundreds of strategies out there that are prediction based trading with all different interpretations of candlesticks, the markets, how to read the chart, with all of these nonsense concepts and theories that don't exist in real life and only exist in the online trading industry. So I'm not surprised why I was so confused with trading 10 years ago and why many traders are still today. But there is only one way to actually read a chart which doesn't require the need to know or predict what direction price is going to go. And I can guarantee you this will change your entire perspective of trading forever. In this video, I'm going to remind you how we all learned how a chart is created and what it actually is, and how to read the chart the only way that is factual and not based on theory and concepts. So you can finally trade in a way that you actually understand and makes sense to you, that allows you to be consistent. Because at the end of the day, when I'm placing my trades, I don't want to risk any of my capital based on concepts, predictions, theories, or what I think will happen, where I can't relate any of it to real life and doesn't actually make any logical sense. Because that is what kept me going in circles for years, struggling to be consistent on why emotions got involved. And frankly, I am sick of seeing the confusion being created in this space. So we need to make sure we understand the makeup of any chart first, because that is the main source of information we use for any trading decision. Back to the real basics. A chart is built from two pieces of data. You have your y-axis and your x-axis. X-axis is the horizontal line and y-axis is the vertical line. Only two pieces of data are inputted there. Time as your x-axis and price as your y-axis. Put the two pieces of raw data together and that is exactly how a chart is created. The entire purpose for any chart to be made is so that the raw data can actually be viewed more clearly. The raw data is purely just records of price history. Nothing more, nothing less. That is it. So the chart is exactly the same. It is recording what the price is for every single time frame. It is fact, and the raw data cannot and will never be able to tell you the direction of where price is going to go next. It is just showing you exactly what happened at every single price the market reached in history. This is why timeframes cannot determine the strength or the probability of any trade. A time frame is a zoom tool. It doesn't and shouldn't determine whether you only take trades on the daily time frame or the 1 minute time frame. There is just a lot more data that can be seen on the 1 minute time frame compared to the daily time frame. That is you being able to see the price data in more detail. Let me show you exactly what I'm talking about. So this is the price history of pound against US dollar every day for the last 6 months. You have time in one input of data, and then you have price on the second piece of data. That is how a chart is created. If I was to make this into the chart, this is what it will look like. And this is exactly what it looks like on the charts that we actually trade on. So it inputs every single piece of data, i.e. price the market reached every day for the past 6 months. Now this could be the average price for that specific day. It doesn't show us the small movements in between on that day. So it might be the close or the open of each day. So on the 29th of January this year, it might have opened or closed at 1.3795. But what we can't see is whether it went up or down throughout on that specific day. It just opened or closed that day, or maybe it's an average for that day. But once you put that data on there, you get a graph, a chart. That is how you build any chart. So that is exactly what our charts are showing us. Just price history over a period of time. Now, if I didn't have this chart, it would be very difficult for me to get any information from this actual raw data. But straight away, I have highlighted this one. 1.38. When the market reached this price on the 20th of January, whether it is close or open or the average price for that specific day, we can see what happened when the market reached that price. Because the next day it went down, the day after it went down, 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 and it kept going down. it went down to 1.32. So that is over 600 pips. So that is the price going down. So what that tells me, based on fact, based on the data, is that when the market reached around 1.38, this is what happened. The price went down from there. So if I asked you, where would you look to sell on pound US dollar, just based off that raw data, where would you sell? What price would be the highest probability where you could see price pull back from? 1.38, because the evidence from the raw data, which is displayed on the chart, is telling you that exact thing. If we look on the actual chart, so we're looking for 28th of January, so it would be this column here, or this day here, which was at its around here, yeah? So this is current market price. If price was to go up there, I would be already making that decision. I would be selling there. Because you said the same thing, because the evidence is showing me that. The raw data is showing me that. The graph also shows me that. The chart is the information source. We just need to know how to read the chart exactly how we did when we was back in school. The second thing is with time frames. Look at time frames, okay? The confusion is that traders are led to believe that time frames determine the strength of any single trade, but it doesn't. It just allows you to see the data in much more detail. So for example, this is the daily chart. I cannot see what happened or what prices the market reached during that day. So in order to look in further in detail on that specific day, I need to use time frames. Which, if I go to, let's say, the 15-minute time frame, this is exactly the same data that would make up the chart. I'll do exactly the same thing here. So essentially, as you can see, price barely moved on that day. Overall, it barely moved. We can see a straight line. Price barely moved, and this is exactly what the data is representing. It is showing us exactly that. The market price barely moved for that specific day throughout the entire day, every 15 minutes. And this can go into much more detail using the time frames that is available to us on our platforms. That is why timeframes cannot determine the strength, the probability of any single trade, because it is just allowing us to zoom in to the data and zoom out of it from what we can see in a particular amount of time. So every 15 minutes, this is the price or the closing price, and this is what happened. That is the makeup of a time frame. So in a 15-minute candle, you can only fit this much amount of data in it, and that is exactly what the time frames allow us to see. But what didn't change is whether the market actually reached that price and whether it went up or down from there. That is still fact. That is still within the data that makes up the chart. If I didn't use the time frames, I wouldn't have been able to see the finer details of what happened when the market reached particular prices. That's what time frames are for, because on the daily chart, it's only giving me an average of one price. But if I drop down the time frames, and I can see, okay, where specifically did price really react from and pull back from? What price was the lowest it reached within those 15-minute intervals or time frames, and then it started going up or started going down. Either way, that is what time frames is for. I hope that clarifies any argument whether there is a secret time frame or not. There isn't. The secret is in the data. The time frames allow us to see the data in much more detail. So now we know how a chart is made up from. This is pound US dollar. Okay, on the right hand side you still have price, and at the bottom you still have time. The same makeup of the raw data. So it's telling us when the market reached a particular price, it went up or down from there. Yeah, so we cannot make any predictions of where price is going to go up or whether it's going to go down, because there are so many concepts out there that is purely based on the visual representation of the raw data. For example, candlesticks. If your entire methodology is based off candlesticks, the way the data is presented, you are not actually trading based off the data anymore. Let me explain. There are concepts like fair value gaps. I don't know what a fair value gap is, but I assume that it needs some sort of candlestick to tell you something. There are candlestick patterns, but as soon as you change the display of the actual raw data, to a line chart, the strategy is gone. You no longer have candlestick patterns that you can rely on. And the only thing that changed is the way the data is presented to you, how you can see it. But the reality is the data never changed. The data is fact and will never change. But the way you see a chart can change. So it doesn't make sense how candlesticks are the reliant or the secret formula in order to trade. My trading is based off the data, what I can actually see from the chart, what it's actually telling me, stripping it back to the basics, right? Back to how we looked at the raw data and how it's actually interpreted. Instead of trying to predict where price is going to go, plan for whichever direction price does go, because the chart is telling you exactly that, okay? So for example, if the price is to go back down here again, what is the data telling us? Once the market reached around this price area, what happened? There was clear interest there. That's what happened. Otherwise, the market price can't have gone up. But that is proof that there must have been interest there. There were buyers of the pound against the US dollar there because price went up from there. It's impossible for price to go up if there was no interest there. That is where the raw data's come from. If I was to ask you, where would you next take your buy? Would decide to take a buy around this price area based off evidence, based off proof of what the chart is showing me exactly what happened the last time the market reached that price. I am more confident and comfortable of risking my capital, i.e. taking trades based off evidence from a chart, the raw data of exactly what happened in the past, rather than trying to predict or trade based what I think will happen, either through fundamentals, either through these concepts and theories that do not exist in real life. Because as soon as you change the visual of the data, it's gone. Your argument's gone. The strategy's gone. It doesn't work because these theories and concepts do not exist in real life. If this was called anything else, not pound against US dollar, you would read the chart exactly the same way. You would read it as once the market reached the price of 1.318 area or 1.317 area, the price went up. That's it. So the next time it gets there, what can you expect to happen? Especially after a significant change in price into there. So that allows me to plan my trades in advance without having to make any predictions at all. I find areas of interest where there is evidence on the chart showing me there must have been an interest there to make the price go up or down. So whether it's an intra-key level or whether it's a break retest, there used to be a interest there, because once the market reached that price, something happened. Price went up or price went down. So the next time it goes there, after a significant change in price, what is the highest probability of the market doing the same thing again? Because the probability is based on how you read the chart and how everybody sees the chart. Because if everybody sees this exact same chart and reads it the same way as we normally should and would, then they would think the same thing. Once the price got to this price again, there is no evidence to tell me that price is going to go below this price level. It doesn't mean it's going to reverse from this price level. It just means there is a high probability of a pullback, because me, you, and everybody else think the same thing will happen. Because the last time the market reached there, that is what happened. So the next time, I'm going to think the same thing. There is a possibility for that. There is a higher probability based off evidence that is more likely to pull back from then than it is to go through and below that price. That's where the probability comes from. And the second way of creating probability is the size of the move into that, because it's a significant change in price. Remember, it's price. When anything goes half price or moves significantly or changes price significantly in real life, it creates demand. If whatever you're looking to buy, the house, the car, the watch, even your groceries, if they're on sale or have a discount, the probability of people buying increases. Hence why every single organization out there offer discounts, because they know it increases the probability of them making a sale, i.e. increasing the probability of demand and buying whatever product they're selling at a discounted rate. So when the price changes significantly on the chart, for me, that is how I see it. I see it as a discount. Price is getting cheaper and there is evidence where price could pull back from. If it reaches there after such a significant change in price, I have two variables creating my probability that is more than the opposing probability. There is no evidence or information to suggest otherwise. There is no guarantee, that's for sure, and that's why it's called a probability. So let me show you actually on a chart, because this is exactly how myself and my clients ran through the charts planning with him. Okay, so he found this entry key level, which is exactly what happened the last time the market reached this price. Once it reached this price, the market pulled back. Okay, so we're not looking or thinking price is going to reverse from there. We're just planning for price to pull back, and we're just looking to capitalize on that pullback, because that's how trading works. Traders buy something for a lower price, sell it for a higher price, make a profit, and move on and sell the exact same product over and over and over again. And it turns into a long-term, sustainable, profitable business. Because what they don't do is they don't buy a product and then predict the price of it is going to go up. That's not a business. That is an investor. That is not a trader. A trading business just purely relies on the volume of transactions repeatedly. And you take a bit and you move on to the next trade. You make money on the next trade. You keep going and going and going. They are not buying a product and trying to hold and hold and hold forever. So this was a planned trade my client took. This is exactly what happened when the market last reached around this price area. Whether that is a line graph or in raw data form or candlestick form, this is exactly what happened. And then the market, from the current price at the time, would it be considered a significant change in price? Yes, it would. It would be 190 pip move into that price level. Okay, that would be a significant change in price. He set his stop loss. You set your TP the same way you identify an entry. And this is how it played out. There was no prediction that needed to be made. There was no reading the chart in any fancy concept or theory used. Okay, it was simply reading the chart exactly what it's showing us, built from the raw data. We all know how to read a chart. We all learned that back in school when we was 10 years old. I am begging every single trader that is still confused to look at trading in this form, because this in reality, in real life, is exactly how traders trade any product there is out there. And I'm going to show you that right now. This is, for example, a watch trader. This is for a watch trader, right? This is for a specific Rolex model, Submariner no date, from production years 2020 to present. Okay, and this is the price history for this specific Rolex watch within a 4-year period. Okay, now let me ask you, as a watch trader, if you was a watch trader, if you had one of these watches in stock and someone offered you $16,000 to buy that watch off you, would you sell it, yes or no? The answer is always going to be yes, because there is no evidence suggesting that price would go above that. If you was waiting and you turn that down, you are essentially waiting for an offer that is $17,000, $18,000, but there is no evidence to suggest that. But if you was offered around $16,000 for that watch, you would definitely sell that, because you are maximizing the most profit, because that's the highest point the market ever reached for this specific Rolex. So I would automatically have a sell order around $16,000 straight away. Okay, and if I had it in stock, no matter what, whoever offered me that price, I will sell it straight away. That's the same principle. Now, the other principle is the current market price is around here. So I'd probably say $11,200, $11,300, right? So that means that is the current market price in the gray market. That's what they are selling for. So if I was offered one below $11,000 around here where market dipped, if I was offered that today or tomorrow or next week, would I buy it as a watch trader below $11,000? It might be $10,800 on there. You would buy that straight away. You already have your order set, because you know that is $400 cheaper than the current market price. You know you would be able to, or have a high probability to make a profit on that watch because you are buying below the current market price. That is what is meant by buy the dip. Every spike, everything is just a temporary change in price. And if it's a significant change in price, it is more likely to pull back to wherever it's going to reach based off the evidence on the chart. Okay. And if we zoom in, because remember, we don't have time frames, unfortunately, and all of these data points are probably inputs of daily average prices throughout those years, because there wouldn't be enough space to fit 1 minute or 15-minute raw pieces of data on this chart. If we bought one today, we wouldn't predict whether price is going to go up from here or down from here, because there is no evidence to suggest that. Do you believe that a watch trader would buy this specific watch based off what they think where price is going to go? No business would actually do that. They would only buy this specific model watch if it was below the current market price. And the way it works in real life is that every customer that they see will offer them their watch. So for example, if you wanted to sell your watch to me as a watch trader, I might offer you $10,000. Another customer might come in, I'd offer them the same deal. One might accept it, one might not. At the end of the day, I have still bought at $10,000. That is my price. Yeah, that is the price that I can see on the chart, which the market bottomed at. Once the market reached that price, it pulled back from there. Okay, it hasn't gone below that. But if it does go below that, well, I am in for a bargain because I have bought a watch for stock below the current market price and I can sell it from higher price for a profit. If we had one in stock and someone offered to buy it for 11.5 grand and we bought it for the current price, we would sell it. We would sell it, but we wouldn't predict whether price will get there or not. It's just that if someone offered to buy my watch in stock for $11,500, I would sell it because there was an interest there before around that price. And the last time the market reached that price, the price went down from there. People sold there the last time too. Forget about that watch, I'll move on to the next watch. And then I just have to wait for those opportunities to come every single time. And none of those decisions were made based off any of these concepts of candlestick patterns, market structure, liquidity sweeps, fair value gaps, inversions in manipulation, distribution, you name it. None of those concepts or theories were discussed because they don't exist in real life trading. Real life trading offline is no different to trading online, because the only difference is if this chart was called pound US dollar, suddenly there's all of these new concepts in order to trade, and it doesn't make sense. It doesn't make logical sense, and that's why I honestly struggled to understand why I was risking my capital based on something that I do not understand practically. It's not logical. It doesn't relate to real life. But when you apply that real life thought process into trading online, everything makes logical sense. So your reasons are different for why you're taking trades, and your way of trading changes entirely because you are no longer predicting where price is going to go, and you can actually just plan every trade in advance because the market or the chart shows you exactly what happened at every single price level in history. And if it pulled back from there, if there was an interest there before, you can and we can and I do expect a possible pullback from there as well. So how do we actually read a candlestick then? So for example, this is a candlestick, right? That tells me enough information. Okay, because the wick is what tells me exactly what happened. It means once the market reached this specific price, the bottom of it, the end of that wick, it rejected. Price pulled back from there. Hence why there is a wick created. Once the market reached that specific price, it pulled back from there. Price went upwards. That just tells me there must have been an interest there in order to cause price to pull back, therefore leaving a wick, creating a wick of a candlestick. The body and the open and the close mean absolutely nothing to me. It doesn't give me indication of what happened at those prices. It just tells me within that time frame, within that day, the market closed at that price and it opened at that price on that day. That doesn't tell me anything. But the wicks itself, the candlesticks, tell me everything I need to know. So once the market reached this price, it also pulled back. It pulled back and created the wick. So the most important part of any candlestick for me is always going to be the top or the end. There is no difference of how they look. All of them look different, but they tell me the exact same information. They all tell me once the market reached a certain price, it went up. It pulled back from there. i.e., there must have been an interest there. That is real evidence of that. That is fact. That is from the raw data the chart is built from. Every single price. Okay, so look, for this, for example, there was an interest around this price level, right? Because there are intricate levels or wicks where price kept pulling back up. So once the market broke that price level, we can expect a potential interest around this price level again. And that's exactly what happened. Price pulled back from there. There is evidence on the chart that there was an interest there. So once price broke through that and price retested it again after a significant change in price, there was going to be a probability higher than it's not to pull back based on evidence, based on fact, rather than a prediction. And we could have planned that trade well in advance without being at the screens, without wasting our time reading any fundamentals, without learning any of these concepts, without learning any of these candlestick patterns, chart patterns, or anything. Because the raw data, which this chart is showing us exactly all of the information that we need to know to decide to make any trading decision. I really, really hope this clarifies so much and changes your entire view of trading. Trade what you see, not what you think.